Okay. Um, Good afternoon, everybody, and welcome to our webinar this afternoon. I'm Julie Sanderson, and I am the event director for the Toledo Regional Chamber of Commerce. And thank you for joining us today for the Business After COVID-19 PPP Loan Forgiveness Strategies and Recovery Best Practices webinar. Before we begin, just a few logistics and housekeeping items. If you would have all been automatically muted when you came in, but you do have the ability to unmute yourself for questions. But while the presentation's going on, if you would just pay attention to keeping yourself muted, that will really help us reduce some of that background noise. Feel free to ask questions during our presentation. You can do that by putting those in the chat function, and I will be monitoring that. There may be some things that I know will be covered, so if I don't get to your question during the presentation, know that we will try to cover all of those either throughout or at the end, so you can type those in there. You can type them to the whole group, or if you prefer, you can just type them directly to me in the private function. So you know, we will have that opportunity for Q&A at the end as well. So, anyway, we will get started with our presentation. So with government lockdowns being lifted across the country, business owners are shifting their focus to the restart of their operations. Understanding loan forgiveness, maximizing funding, and having the right tools in a plan for recovery should be top of mind right now. So that, with that being said, we're very excited to have William Vaughan Company with us today. They're a chamber partner, and they've been very instrumental in guiding business owners through the complexities of loan forgiveness utilization innovation tools like the forgiveness calculator that you'll hear about today. So with that, I would like to turn it over to our speakers. Joining us today are Kate Matz, an advisory service partner with William Vaughan Company, Dave Hammock, a tax partner with William Vaughan Company, and Sandy Towns, also a tax partner with William Vaughan Company. We hope you get a lot out of today's presentation, and with that, I will turn it over to Kate. I believe you are unmuted and ready to go.
I am. Thanks, Julie. Well, we're really happy to partner with the Chamber today to bring some of the other Chamber members some timely information and hopefully answer your questions and see what we can do to clear up some of this. It has been a bit of a journey here to figure out what PPP is, how it works in forgiveness, and the rules keep changing on us. So what we'll talk about today is everything as we know it, as it currently stands, some things that might be changing, and then we'll all have to kind of stay tuned for some potential future changes to come. So I am going to start out and just walk through forgiveness as a big picture, how it works, what the calculation is, and then what some of the components are, and then we'll talk a little bit about some best practices and then get into your guys' questions and answers. So looking at forgiveness for the PPP loan, there's three kind of main steps that you can boil it down to. The first step is to look at your payroll cost, your eligible non-payroll cost. Add those two together and you get the total eligible cost for forgiveness. And we'll go into some details on what makes up each one of those here in a minute. But for right now, payroll plus the eligible non-payroll gets you the total eligible cost. Step two, then, you start looking at some potential reductions that you might have to take. So the first one is related to payroll. So you take payroll divided by 75%, and that gets you the payroll 75% requirement. This is actually something that was not included as part of the CARES Act that created the PPP, but it was later put into place by one of the interim final rules. And what it states is that to obtain full forgiveness of your loan, you need to spend at least 75% of those dollars on payroll-related costs. So that's the first part of step two. Second part of step two then is to look at your total eligible cost and then some potential reductions that you might have to take on that. So one is a wage reduction. If you reduce employee wages by more than 25%, you'll have a potential reduction there. The second then is FTE reductions. So if you have fewer full-time equivalent employees during the period of usage of your loan compared to a prior period, you might have a reduction there as well. So you take those two things out of those total eligible costs and you come up with this modified potential forgiveness number. Moving into step 3 then, you do a 3-way comparison. So one is to look at that payroll 75% requirement that you calculated out in step 2. Also compare that to the modified potential forgiveness that you computed in step 2. The third then is to look at your PPP loan amount that you received. So you take those 3 numbers and it's the lesser of the 3 of those that becomes your forgivable amount. So what does that mean? Well, 1, you can't have more forgiven than what the actual PPP loan amount was. That makes sense. 2, you have that 75% payroll requirement. So to obtain that full amount of forgiveness, you have to spend at least 75% on payroll. Anything less than that is going to bring down the amount of forgiveness that you'll be able to achieve. And then third, that modified potential forgiveness, if you reduced wages or salaries by more than 25%, or you reduced your headcount, you're going to have, you're going to get dinged there and be able to not be able to have that full amount of reduction. So let's dive into some of the details now on what each one of these means. So we'll start out with payroll. And for payroll, you can either use the covered period or the alternative payroll covered period. So when the original guidance came out in the Act, there was this covered period that was 8 weeks, and it started on the day that you received your loan funds and went out for those next 8 weeks, and that was the covered period. So that was the amount of time that you had to use those funds that you received for your PPP loan according to the eligible rules that they had determined, and that's the amount that then you could count towards your forgiveness. A couple of Fridays ago, when they came out with the application for forgiveness, they introduced a new concept, which is this alternative payroll covered period. What that does is provide a little bit of flexibility on payroll, and depending on how your payroll periods work, it could actually mean that you get to include a little bit more payroll cost in your calculation. It also means that it can make it just a little bit easier administratively to line things up with your payroll period and your loan period. So this alternative payroll covered period, it allows you to have the choice again. You can pick which one, but you can have your covered period for payroll start on the first day of the first payroll after you've received your loan funds, and then go out that next 8 weeks. So you get that choice. We'll dive into that just in a second here in a little bit more detail and kind of show you some scenarios and how that might play out. Another thing related to payroll to be aware of is this $100,000 annualized limit. So just like on the front end, when you applied for the PPP loan, for each of your employees, you were limited to $100,000 of annual compensation. You have that same limitation on the back end with forgiveness. So for 8 weeks, when you kind of do the pro rata on the $100,000 annualized amount, that's $15,385 that you'll be limited to for each person. Payroll is calculated off of gross pay. So we still do get some questions from folks on, is it gross pay or is it net pay? What do you do with taxes, other withholdings? Payroll is based off of gross pay. So start with that gross amount that you're paying to your employees. Then on top of that, you add the company paid health insurance, any company retirement contributions, and then the state unemployment taxes that the company paid as well. Unfortunately, one thing that did come out in some recent guidance is that for owners of the business, and so this could be if you're a self-employed owner or if you're a partner in a partnership, any owner, the compensation amount is just the cash compensation. You are not able to include any of the health insurance or retirement benefits for the owner employees, just the non-owner employees. All right, so let's look at this covered period and alternative payroll covered period a bit more. So this is an example here of how payroll would work out using a covered period scenario. So this assumes that you have a loan date of 5/6, so May 6th, And all of the kind of light green bars here show what the payroll periods are. So the first payroll period that's showing would be April 27th through May 10th there, so 2-week period. The blue circle is payroll begin period, so that's on that May 6th. The purple circle is the covered period end date, so all the way down there on the 30th. And then the green circles are the pay dates, so when the payroll actually got paid. So for that first payroll that started on April 27th and goes through May 10th, May 14th is the first pay date that falls inside of the covered period. So how this would work for the covered period for PPP forgiveness is you get to include all amounts that you've paid. So you would include here the payroll that you paid on the 14th, 18th, 11th, and 25th. And then you also get to include amounts that you incurred after those dates. So everything that was in the yellow.
Kate,
Yes.
I have a question that might, before you get too far into that, are dental, disability, and life insurances forgivable?
Dental, disability, and life insurance. Yes, we believe that they are. So there isn't anything specific that includes or excludes them in the guidance. But if you kind of take a broad view of employee benefits, I would say yes, include them. And barring any sort of guidance that specifically excludes them, I'd always kind of err on the side of putting those types of things in. I think that there is certainly rationale to do so.
Thank you.
All right, flipping over to the alternative payroll covered period now. So now you can kind of see these side by side. So with the alternative payroll covered period, this allows you again to start that 8-week period for payroll cost on the first day of the first payroll after the loan date. So loan date again is 5/6, but now we're going to shift the beginning of the 8-week period down to the 11th, which is the first day of that next payroll date. And then that shifts our end date from the 30th down to July 5th. And here we're actually able to start picking up a little bit more payroll cost. So we still have the 14th, 28th, 11th, and 25th paid payroll dates, but now you can see we're actually able to stretch it out and include some additional days of incurred pay that haven't yet been paid, but that will be paid on the next payroll date. So this is an option that's available to companies that have payroll cycles of bi-weekly or more frequent. So unfortunately, it's not open to all companies to use, but if you are a company that has a bi-weekly or more frequent payroll cycle, it's worth kind of laying these scenarios out and seeing which one is going to be more favorable for you for either the covered period or the alternative payroll covered period. All right, so that takes care of payroll. We'll shift down now and talk a little bit about those eligible non-payroll costs. For the eligible non-payroll costs, that is only for the standard covered period. You don't get an option here to kind of use a different date. It is just those 8 weeks beginning on the day that you receive your loan funds. These costs include mortgage interest on both real and personal property, rent on both real and personal property, and utilities. And these agreements must have been in place prior to February 15th. The kind of purpose, what they were trying to accomplish with the PPP program, was to provide companies funding to enable them to continue kind of business as usual. So whatever sort of normal business operations you had going on prior to the COVID crisis, this funding is to go towards those types of things. Idea was not to provide funding for investment or expansion or anything like that. So that's why they kind of picked that February 15th date that said these must be for things that had already been in place prior to that date.
Kate, are those on a cash or accrual basis or both? And are internet costs included in utilities?
Yep, so those are on a kind of cash and accrual basis as well. So all amounts paid as well as all amounts incurred, so long as they are paid on the next normal pay date. So at the beginning of your 8-week period, you're going to be able to include amounts that you're paying then that you've actually incurred previously. At the end of the 8-week period, you're going to be able to include things that you've incurred but haven't yet paid, so long as you pay them when they are normally due. Yep. And then internet costs, yes, internet costs do count as utilities.
Thank you.
All right, let's shift down and talk about the wage reduction a little bit. So wage reduction, I mentioned before, that is for any salary wage reduction that's greater than 25%. So if you have anything up to 25%, you don't need to worry about that. Once you hit more than 25%, now you got to work through the math to see if you need to do a reduction there. Any employees that earned over $100,000 in 2019 get to be thrown out of this calculation. And the way that they've defined this isn't maybe what we would think. You can't just go pull the W-2 for 2019 and see what somebody made. Instead, they're saying, hey, look at each individual pay period throughout 2019. And if in any individual pay period for 2019, you annualize that dollar amount, if that is over $100,000, you're able to exclude them. So this means if you've got somebody that had earned something less than $100,000 for the full year of 2019, but maybe they had a nice bonus in one pay period, if you take that bonus pay period, annualize that out, and that's over $100,000, then you can exclude them from this calculation. Last point on here gets to the safe harbor option. And so if you have reductions that you did that were over 25% that would result in taking a wage reduction, there is the safe harbor that if your reductions took place between February 15th and April 26th, then you can cure that reduction by bringing those wages back up to the February 15th amount by June 30th. And if you do that, then kind of everything that happened before is forgiven and you don't need to have any sort of reduction for wages. Gets a little goofy though. There's a lot of different time periods that come into play here. So if you have some of these things, you really need to take some time to schedule that out. And we'll talk a little bit later about a calculator that we're making available to folks that will help in that. Next item then is the FTE reduction. So FTE stands for full-time equivalent, and this is computed off of a 40-hour work week. So earlier on, we were all kind of thinking that this was going to be based off of a 30-hour work week and was going to line up with some other laws and rules that are out there, particularly the Affordable Care Act uses a 30-hour work week to determine full-time, but this is a 40-hour work week to determine full-time. So anybody that works normally 40 hours or more is an FTE of 1. Anybody that works less than 40 hours on a regular basis is something less than 1 FTE. So take that amount that they normally work, divide it by 40, and you're going to get the proportionate FTE that they are. So you're going to kind of do that for each and every employee, look at where they are for the cover period. You compare it back to a prior base period. You do have a couple of options there as far as which base period to use. And if you have a reduction, it's going to be a proportionate reduction to those potential forgivable costs, unless you meet a safe harbor. So we have that safe harbor that we talked about with the wage reduction come back into play here with the FTE reduction. So if you have FTE reductions that happen again from February 15th through April 26th, and you restore them by June 30th, so you bring them back up to at least that February 2015 FTE number, you do not need to have a reduction for FTEs. Again, gets a little complicated with a lot of the different periods, but kind of have to work through scheduling those all out, doing the math and all the comparisons. All right, now I want to just go over some potential changes that might be coming. Again, I tell you these things just to kind of stay tuned on what's going on in Congress. Don't know that this is going to happen. I wouldn't be surprised if at least some sort of flexibility is provided compared to where we are today. But this is what's on the screen here, some kind of key items that were included in the House bill which was passed last week. The Senate is taking it, or supposed to take it up for vote this week. I'm not sure which day, but quite a bit of flexibility here that would be added to this forgiveness. That 75% payroll requirement would go down to 60. The 8-week covered period moves out to a full 6 months. That 6/30 safe harbor date moves all the way out to December 31st, end of the year. There's some leeway that would be added in if you aren't able to rehire people because of some safety concerns. The repayment period on the loan right now is pretty quick. So if you aren't able to have it all forgiven and you've got amount that you roll over into a loan, currently it sits at 1% interest and a 2-year repayment period. This would extend that repayment period out to 5 years. And it'll also allow for some payroll tax deferral that right now it's kind of an either or. You can do this payroll tax deferral or get the PPP loan. This would allow you to do both. So lots of flexibility that's offered here. We'll kind of wait and see what happens as it works its way through the Senate. So more to come on that. All right.
Before your next slide, there's a few questions that are appropriate to this. What if there were FTE reductions for just cause? What if the employee refused to return or quit on their own? And is FTE based on average hours for the 8 weeks?
Yeah, so the first couple there, if somebody was terminated for cause, or if they were offered their job back and they did not take that job back, as well as if somebody just left on their own accord. So all of those are reasons to get an exemption to that FTE reduction. So you would just need to have documentation of those items in the file. And as you kind of work through the application, or our calculator will kind of help you walk through this, you would be able to have an add back for those items so that you are not harmed. So basically, they're trying to get at, you know, if company, if you made the decision to have these reductions in FTEs, we're going to ding you for that. But if you had a reduction in FTEs because your employees made the decision, we can't hold you harmless for that one. Julie, I'm sorry, what was the second part of the question, or the last part?
Is FTE based on average hours for the 8 weeks?
Yes, it is based on average hours for the 8 weeks.
Kate, will somebody, if everything passes this way, will folks need to reapply with their bank, or is the extension automatic?
No need to reapply. This all deals with just how the forgiveness works. So there's an application for forgiveness that you will submit to your bank at some point after the end of your covered period. So right now, nobody, even the people that are early on with getting it, haven't quite hit the end, but man, they're getting really close. They should be right about coming up on their 8 weeks, but nobody's hit it quite yet. So this will all change the forgiveness application process and the rules around it. So no need to reapply for the loan itself. It's just going to change the forgiveness application that you will fill out at some point after the end of your covered period.
Great, thank you.
Yep. All right, I am going to turn it over to Sandy now to talk about some best practices.
Thank you, Kate. So we're talking about maximizing forgiveness and what are the ways that you can make the most out of this. The first one, we're talking about paid and incurred eligible payroll expenses. That goes back to what Kate was talking about with your different pay periods and how you can include any payroll that you pay during your 8 weeks, as well as any payroll at the tail end of it that you've incurred but has not yet been paid, will be paid on the next regular pay period. So that kind of gives you an ability to include as much payroll as possible into that period. If you're looking at paying bonuses or hazard pay, to the extent that that makes business sense and you feel that your employees deserve one or the other of those, you certainly can do that, and that will be includable in the payroll costs. The things you need to keep in mind there are, for instance, that it can't be more than $15,385 per person for the 8-week period. And the other thing you need to keep in mind is that when it comes to owners, it also can't be more than the $15,385 And owners are also subject to an additional limitation where their pay cannot be more than what they were paid in 2019. So if the owners were paid something less than $100,000, you can't bump them up to that in order to maximize your forgiveness here. But when you're talking about owners, it does not include family members. So if there are any other family members who happen to be on the payroll, they can be paid bonuses or hazard pay or something else up to the $15,385, and it can be more than they were paid in the year before. As far as profit sharing contributions, to the extent that you're making matching contributions to your employees' payroll, you certainly want to go ahead and pay those. Those will definitely be includable. If you have an annual profit sharing contribution that you make that's still due, that you have accrued from 2019 and have not yet paid, as long as you would normally make that in this time period, you can go ahead and pay that as well. As of right now, there's no guidance saying that that would not be includable. So you could go ahead and pay that as well. As far as catch-up rent and prepaid rent, the rules regarding the non-payroll items say they have to be either paid or incurred. So there does not seem to be any prohibition to paying any catch-up rent, any rent that you still owe from previous months or years. As far as prepaid rent, though, it would have to only be rent that was incurred during that time period. So if it was incurred during the 8 weeks and paid in the next regular rent cycle, you could include that, but you can't prepay your rent for the rest of the year. That would not be includable. There is a specific prohibition against prepaid interest. So when you're looking at the mortgage interest piece of it, you can apparently include any interest that's in arrears, any past due interest, but not any prepaid interest. And of course, this would not include any of the principal payments of the loan. This is just the interest piece of the payments that you're making. As far as appropriate documentation, the forgiveness application that the SBA has put out has about a whole page list of documentation that needs to be attached to the forgiveness application. So it would probably be a good idea to take a look at that, make sure that you're keeping that stuff as you go along. It includes everything including, for instance, that your rent has to be in an agreement that was in place as of February 15th, and you're going to need to provide documentation that proves that. There's going to be documentation pretty much to prove everything that's on the application. So it would probably be a good idea to get that, take a look at it, and make sure that you're putting that stuff together as you go. Next slide. Some tax considerations to keep in mind. While the receipt of the PPP loan is not taxable income, the expenses that are included in the forgiveness calculation also are not tax deductible. That's not the way we believe the intent of the act was written, but that's what the IRS has come out and said, that these expenses are not going to be deductible, but the receipt of the PPP loan is not going to be taxable income either. So essentially it'll be a wash. When you're recording the expenses on your books, you should continue to record them in the way that you normally do, not record them any differently, not put them directly against the loan, just continue to record them the way you normally do. Put the loan on your books as a loan, and when you determine what the forgivable amount is, you'll move that portion over to your income statement, and that'll offset those expenses. But again, it won't be taxable income, it'll just be on your income statement.
Sandy?
Another opportunity, yeah.
A couple of questions that I think relate to that. Is it your interpretation that only business interest expenses on secured debt is eligible, that is a mortgage on real or personal property? And then second, for the purposes of owner limitations, is a shareholder of an S Corp who is also an employee considered to be an owner? Goes back to the previous slide.
Right, an owner of an S Corporation is considered to be an owner. And there doesn't seem to be any de minimis exception that you can be any percent of owner and being considered an owner, even if you have 1% or 0.5%, you would be included as an owner, and S Corporation owners included. As far as the mortgage interest, that would be any business debt on real or personal property is our understanding of how that would be includable. Wouldn't include any, it doesn't include your home mortgage. Would have to be business property or business real or personal property.
Thank you.
Now regarding the deferral of payroll taxes, there is a provision in the CARES Act that allows for deferral of employer Social Security taxes. This does not include any taxes that were withheld from the employee. It's only employer Social Security taxes. And this is if you don't have a PPP loan. If you don't have a forgiven PPP loan, you can defer these payroll taxes. So you are allowed to defer them until that loan forgiveness is approved. If you didn't have a PPP loan, you would be able to defer the employer's Social Security portion of the taxes from March 27th until the end of the year. You would be able to repay those 50% of them by the end of 2021 and the other 50% by the end of 2022. In this case, if you have a PPP loan and it becomes forgiven at some point, at that point you would owe those payroll taxes and you have to pay them then, but they can be deferred up until that point in time. And the employee retention credit is another credit that's allowed, that's only allowed if you do not have the PPP loan. So that's probably not going to apply to most people who are on here finding out how to have their PPP loan forgiven. But there is their employee retention credit out there that's equal to 50% of wages from the middle of March to the end of the year, up to a maximum of $5,000 per employee. And I'm going to turn it over to Dave.
Got it. Thanks, Sandy. Appreciate that. So I think most of us, having walked through that level of detail and we start to kind of grasp what the tax circumstances behind receipt of the loan and the expenses that are incurred that drive the loan, ask rightfully, well, what do we do next? First things first, right? So let's estimate our forgiveness in each of the businesses that you own or operate. Now is a good time to be estimating the forgiveness that you have. Really, if you're beyond that halfway point, that still leaves us some leeway in terms of the time frame to be able to add in hazard pay or bonus pay or make some of those additional changes that Sandy had referenced. After you've utilized the calculator, and you can see here the link that'll be sent out so that you have access to the calculator. After you've run your numbers, the next bit of advice would be to stop, slow down, take a breath, don't do anything else. Why? The House bill that Kate referenced last week passed 417 to 1. There's only one member of the Congress, I didn't bother to look it up, or the House, excuse me, who didn't vote for the bill. It's been well received by both the Senate Minority Leader Chuck Schumer and probably most importantly by Senator Rubio, who leads the Committee on Small Business and Entrepreneurship. Schumer's position, which is shared actually by a number of Republicans as well, is that the House bill is good as is and they should accept it in whole cloth. Rubio's provisions would bump the 24-week down to 16, and he wants some harsher language around rehiring workers. Nonetheless, right, so the minimum that we might be talking about here, guys, with a relatively substantial chance of passing through this week and likely to be signed by the president, would be a doubling of the 8-week period, would include a removal of the 6/30 date and instead give us until December 31st to hit those rehire exemptions, and would include some amount or some change to some of the FTE calculations and the math that Kate adroitly ran us through earlier. So start by running your forgiveness calculation now so that you know where you are, and then slow down. If you're at or near the end of your 8-week period, still continue on, and we'll talk in just a minute and kind of rehash some things that we should be doing to soak up the dollars while we're in the 8-week period and before we have any change in the law. But don't rush to submit anything to your bank. I suppose if you were absolutely certain that you had full forgiveness under the 8-week period, you might be well suited to submit. But frankly, most bankers that we've spoken with as well have said, hey, we're not prepared at this point in time to accept applications. You have 90 days after your 8-week period to submit your forgiveness application. The bank's going to have another 60 days after that to give their ruling. And the SBA has another 90 days during which they're able to review your loan for forgiveness as well. So there's a lot of time in front of us here. And unless you are very, very close to the end of your 8-week period, best advice would be, again, 1, run your forgiveness calculation. 2, stop, slow down, and at least wait and see what happens this week. Certainly, after you've run your initial calculations for forgiveness, start to think about what it might mean to soak up the additional dollars, whatever is left in your calculation. I'd be running those 2 ways. I'd run them the 75-25 method and preemptively on a 60-40 basis as well. Take a very, very critical look at the FTE reduction and wage reduction calculations, guys. Those are things that we can cure as business owners, either by the June 30th deadline or by the 12/31 deadline. But if you haven't run through the math to know where your gaps are, you're in trouble, right? So we've got a sort of a panacea or a cure-all coming here either in June or December, depending upon what the Senate does this week. But you need to know where you sit before you enter into just assuming you're going to get full forgiveness. The overarching theme I think you get from our team is to use good business sense. Understanding, guys, that if your loan's under $2 million, you immediately meet the necessity standards set forth by the SBA and by the Act. Well, if that's the case, then let's be honest about what we have. To the extent that you have a loan that isn't forgiven, it's just that, it's a loan. And it's most likely, with no guarantees, but most likely that if the Senate takes up and passes something akin to what the House has passed, you're going to have a 5-year loan at a very, very, very low interest rate. And for the business owners on this call, I would suggest to you that if I'd come to you at the end of last year and said, hey, how about I give you a loan for 5 years at 1%? Most of you would have taken it, right? So again, step back and breathe. If the worst that we're left with, guys, if the best thing for your business is to be left with a loan with an attractive amortization term and interest rate, we don't think that's the end of the world, right? Maximize the deferral, the payroll tax deferral that Sandy just referenced during the time frame as well. Make sure that you're checking with your payroll team on 2 things. 1, that they are deferring the employer side of the Social Security tax, and 2, that you are absolutely still remitting all other required taxes. Hey, we're all human. Anything can happen, right? And where one side of the calculation is perhaps deferred, sometimes it's easy to mess that math up and the employee side doesn't get sent in or get paid. Transparently, this, we get most concerned about this probably for those that aren't using a payroll service, a third-party payroll provider. Why is that a big deal? As most of us know, any of those withholding taxes or payroll taxes that are not paid in are considered trust fund recovery items. Major, major, major tax problem if they're not paid. So again, use good business sense, maximize the deferral of the employer side of the Social Security tax that Sandy referenced. Check with your payroll team to make sure you're still paying and everything else that you're required to. And then at that point, right, once we have some additional guidance, start to get creative with the money that you have in front of you. Hazard pay, bonus pay, rent payments. Look at the agreements you might have between your various businesses. If you have multiple entities that share space and that filed for PPP loans, check to make sure that you had those lease agreements, those leasing arrangements in place before February 15th between the related entities so that you can shift funds for rent between them. Get with your attorneys and make sure those documents are in good working order. The option is there. If you get to the end of the term and you have unused funds, feel free to kick it back. We would, again, just caution, right? And I think that what we're seeing from the House and likely from the Senate is a recognition that this is not a short-term situation that we're dealing with. And so returning unused funds, while we've certainly gotten asked that question a lot, and it is certainly an option, I'd again just ask you, right, if I came to you at the end of last year and gave you a 5-year note, or even under the current terms, 2-year note at 1% interest, most business owners that weren't debt averse would have taken that money and repaid it over the time frame happily. And so return the unused funds if you're concerned about some future event or being able to make the payments, but otherwise hold on to the cash and repay it later as a loan. And, again, overarching theme here is you're looking at each of the buckets that Kate referenced and walked through, both from a payroll cost standpoint and from a non-payroll cost standpoint. Make sure that you've got all of the documentation to support your forgiveness. Payroll records, detailed information on the payroll, on the pay period, as she referenced, each of the individual employees, all the utility bills, interest, etc. You need to hold those for 6 years. So this isn't going to line up with a 7-year holding period it might be used to with your tax return. And although we've got this under $2 million loan presumption for those of us who took out less than $2 million, there's a presumption of necessity. SBA still has under its authority a 6-year period under which they can audit or look at any loan. Is it likely they will? No, but I wouldn't want to be the one that was the unlikely recipient of an audit and not have all of my proverbial ducks in a row. So start to get those documents together now, as Sandy referenced a few minutes ago, and keep them in your permanent files for 6 years. We would treat the 6-year requirement, guys, as of the date of final forgiveness, the final determination of forgiveness, not as of the date of your loan start date. Be conservative here. So those would be some immediate next steps that you should be looking at here as we're proceeding forward. Julie, I'm sure there's probably some questions we want to run through here as we move forward.
Yes, there are. There were a few that came in the chat while you were talking, so we'll go through those and continue to put those in as they're answering these if anybody has one. One of the questions are accounting, lawyer fees, lawn care, building or equipment repairs, business property taxes included?
Well, we're actually invoicing only for rent these days. So the short answer is that the items that you referenced, unless I missed something at the end, would not be part of the non-payroll cost. Utilities would be, right? Your rent, your interest, but your professional fees, and any repairs or maintenance to the building, whether owned or rented, are not going to qualify.
Are shareholders in an employee stock ownership trust considered owners with respect to the PPP forgiveness?
So that's a great question. If Kate and Sandy don't mind, I'll take that one, given that I've got a few ESOP clients. So here's what we would say, right? If you own your shares through the allocation inside the ESOP, the Qualified Retirement Plan, we think you're fine, right? Meaning you're not a tainted owner for purposes of this particular calculation for the 15,385 cash comp or otherwise. If, however, you're in a non-100% owned ESOP company, meaning the ESOP, let's say, owns 40%, 60% of the company, then the residue shareholders that own their shares directly, again, outside of the ESOP, which is a qualified plan, would be treated as owners.
One of the business owners asks, my PPP funds were deposited into a bank account tagged as PPP funds by my bank. Do I need to move these funds into my general checking account to demonstrate utilization?
Kate, what do you think?
So wouldn't necessarily need to, probably recommended easier to. A lot of folks, they already have their payment processes set up to come out of their standard checking account, right? So there's ACH numbers that are out there, or bank account numbers, for ACH withdrawals. So we wouldn't say that you need to go through the process of changing all of those things, but if you maybe on a weekly or biweekly basis, just sweep over the funds that were in that separate account into your checking account, keep records of the dollar amount that you're moving over and why. It will help keep it a clean trail. So you don't need to pull the funds from that savings account to make those payments. But if they put them in there, they're kind of expecting it to be used. I think it's just going to keep it cleaner to do that periodically, sweep it over and refund that checking account.
A question, we were limited to 10 weeks of payroll for the loan essentially. Why the big extension to 16/24 weeks?
I think it's just a recognition of the fact that the recovery is not happening in 8 weeks, that it is going to take a lot longer to come back. And some employers are really having a hard time getting their payroll back up to where it was and getting their FTEs back up to where it was in that 8-week time period.
Yeah, particularly, industries like restaurant, hospitality,
Yep.
where they continue to be under pretty strict, stay-at-home shutdown orders, or even if they are able to come back, they are government mandated to reduce the capacity that they can bring in. If they're not able to, they're only able to have half the number of customers in their facility, they don't need to bring in the full number of employees. So recognition of just the length of time that it's going to take to get back to normal.
I think somebody was looking for a clarification on timing. Did you say that borrowers must submit a forgiveness application within 90 days of the covered period ending?
Yes, that's the rule in the act is when your period's up, you've got 90 days. Now that's obviously fluid too, right? If the bank or SBA revises that, but if the act is written as a 90-day time period.
Yeah. Yeah, and to that point, if everybody, and when we send everything out, we'll note that all of this information is as of June 1st. So we know that things are changing fluidly. A couple more questions coming in here. Are leased software licenses considered personal property? Should the proceeds be reclassified to income as expenses are incurred?
So I'll take the first one, right, which is a great question. So the answer is probably yes. To get incredibly obtuse, intellectual property is a matter of state law classification. Most states, Indiana in particular, immediately comes to mind, Ohio and Michigan, treat software and intellectual property as akin to tangible personal property. In fact, you guys probably remember when Ohio had its personal property tax, certain types of software were taxable, were included. So we'd say, hey, so rent is allowed, right, on specific real or personal property inside a business. If your agreement is for the rental of the software, it's not a user access or otherwise, and I'd say you're good, it qualifies. I think the nuance here is to read the agreement. For example, we have, Kate, Sandy and I within our firm, we have a monthly fee that goes out to our cloud hosting company. They maintain all of our servers in the cloud. We're not paying for any sort of lease arrangement with the software or otherwise. We're paying an access fee. And so as we run our calculations, that wouldn't be included. Great question.
Okay. Is a real estate property management company that manages both properties the principal of the management company has ownership in, some 100%, most in the partnership with others, and also manages for third parties properties that the principal does not own, eligible, is a separately owned company which does not own any real estate directly. Or it is a separately owned company.
Dave, you want to take that? I'll circle back and answer the other question before on the on if the loan amount. Okay, so there was a two-parter that Julie asked before. So the one Dave handled. The second one was if the amount should be reclassified as income as the loan was getting used. So the answer to that would be no. So as you get the loan funds in, record that as a loan on your books, and you should actually start accruing the interest on that, because interest starts to accrue right when you get it. So start booking accrued interest. As you have your expenses that are going to be part of your forgiveness calculation, record those as expenses on your income statement just as you normally would. Once you actually get confirmation from your bank that this is the dollar amount of your loan that's going to be forgiven, that's when you're going to take it out of the loan and put it onto your income statement as an other income item. So you're not going to put it up with your revenue, you're going to put it down outside of your operations as other income. But wait until you get that confirmation from your bank that you have obtained the forgiveness and what that dollar amount is. And you would also relieve any sort of accrued interest related to that loan amount as well.
Yeah.
That forgiven amount.
Yeah. Good. And in terms of the property management company, there's no industry specific prohibition on accessing the PPP in and of itself. And in fact, the loan program still has funds and is open through the end of June. May even be open through the end of the year. We'll see what happens here over the next couple of weeks. Obviously, if a property management company doesn't have any employees, then inherently it's going to run into the issue of the actual calculation to get the PPP could be somewhat muted, right? Because that's based on payroll or self-employment income for partners in a partnership. If a property management company has employees, or the income from that management company is treated to the partners in the partnership as self-employment income, good to go, good to apply. And any lease arrangements that it has back, forth, or otherwise amongst tenants or amongst related entities should also qualify for the forgiveness piece of the calculation. But obviously the rent in and of itself won't drive the calculation of the eligible loan.
Are Social Security taxes that have been deferred while waiting for the loan forgiveness due immediately when the loan is forgiven, or subject to 2021 and 2022 due dates?
They would be due immediately because you're no longer eligible for the deferral. So you should set that money aside and have it ready to pay when your loan is forgiven.
What is the look back period for the wage reduction part of the forgiveness?
For the wage reduction part of the forgiveness calculation, you're going to compare your covered period back to the first quarter of 2020.
You did not mention idle advance and how that impacts forgiveness.
First of all, congrats if you got an idle advance, by the way. Congratulations. It's you and no one else. But Kate, you want to talk about the integration there?
Sure. So any amount that you received as an idle advance will unfortunately reduce the amount of forgiveness that you achieve. So you'll go through the calculation, and on the application, you actually come down to, here's the amount of forgiveness. It doesn't even show you putting in the idle amount that you received as an advance as a reduction, but there is a little blurb that says, hey, if you got an advance, we're just going to take it out of what we forgive to you. So that will be reduced, but it's not real clear the way that the application lays that out.
I had a few questions submitted ahead of time, so just a few more here. Again, anybody, if you still have something or you're still thinking about it, go ahead and type it in. But there is a lot in the news lately about companies receiving loans that were not necessary. What is necessary, and how do I need to be concerned about this?
Yeah, so necessary is a vague term that would be incredibly difficult to prove in court, which is exactly why they quickly revise their thinking in terms of those that received loans for $2 million or under. So first things first, to the extent that your loan is not between your affiliate businesses is not over $2 million, you have a safe harbor that the loan is presumed to be necessary. Those that are over the $2 million, there's some extra steps to work through, but laying out necessity is just what we think it might be, right? Cash flow, pro formas, business necessity, everything that went into the thinking in the first place to get the loans. But that's really for those over $2 million. I've had some interesting discussions with folks saying, well, hey, what about inappropriate use of the funds and necessity or otherwise? And of course, guys, we would start by saying, regardless of the size of your loan, if you didn't qualify to begin with, or if you're out buying toys, Lamborghinis, personal items, expect swift and harsh judgment when and if you're caught.
That's a good segue into the next question. What documentation will I need to provide to support my forgiveness application?
Sandy?
Well, as we mentioned, there's a whole page as part of the 11-page application for forgiveness. There's a whole page of documentation that's required, including pretty much everything to substantiate every number that you're putting on the forgiveness application. So we can send out a link to where that you can find that application, so that you can all get access to it and take a look at it and start thinking about it. but it was the basis for our forgiveness calculator that we put together, which you have the reference where to get that. So you can start with that and see where your numbers are, and then take a look at the actual application to see what documentation they're requiring.
Thank you. When you say Q1 of 2020 for the look back period for wage reduction, do you mean FTE on 3/31/2020 or on 1/1/2020 or something else?
So for the wage reduction, you're going to look at what the average wages were from January 1st of 2020 through March 31st of 2020. So it'll be the average annual salary if it's a salaried employee. So if they kind of, if they got a raise during that time, you'd have to kind of factor that in. And for hourly employees, you'd look at what their average hourly rate was for that time period.
And then the last question I seem to have in here, what expenses qualify as transportation costs? As the Act seems to reference that utilities must be part of a service contract.
Dave, what's your interpretation of that?
Yeah, so anyone that knows me knows that I tend to apply liberally. And so transportation costs, what do we think? So I think vehicle fleet, rental costs, leasing costs would qualify. Fuel for that particular fleet would qualify. Would an employee's, let's say, reimbursement of vehicle costs qualify? Not certain. There's some gray area there, but certainly anything directly associated with transportation costs, including the obvious, right? Your Ubers, your Lyfts, your parking, all of that. Until we have guidance otherwise, I would be including those items in liberal doses with my forgiveness calculation.
Great. Well, this was hugely informative. Anybody, if you have a question that comes up, you all have my email address. I will be happy to forward those on. But Kate, Dave, and Sandy, thank you so much for very clearly outlining so much of this very important information. As mentioned, we did record this, so if you need to get some clarification on something, you can watch it later. That probably will be up on our website tomorrow morning, but since you all registered with your email address, I will go ahead and send you that link where you can find that, as well as the link to the calculator that was referenced in here so that you can start filling that out as well. And Sandy, you mentioned a link to that, the page of documentation. If we can put that in there as well, that would be a great quick reference. So, but again, thank you so much for spending your afternoon with us. And Sandy, Dave, and Kate, once again, thank you so much for your great information and for your partnership with the Chamber. It's relationships like this that help provide value to the rest of the members. So we're glad the rest of you were able to sit on this with us. So
thanks for having us.
Thank you.